GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you.
You're saying there's great excitement in the financial markets pretty well across the planet.
Yeah, it's terrific market on the equities, but we should back up a little bit because a couple of months ago the Shanghai SSEC market reached, let's call them technical excesses without going into all the details, and that market has rolled over. Now, you also have a long history of in very excited stock markets as they develop in Europe and in London. There's a tendency for those hot markets to peak in or around May or June, where we are now. And earlier in the year, we put this probability forward. And so now we're getting on the London Exchange and on the stocks, which is the 50 stock, there's their key index in Europe, we're getting technical excesses. And they could, like the London market, it can get a little more extended on these technical readings. And with Europe, you could say it's almost as good as it can get. So, and we're here getting towards late May. And when you have one of these targets like this, you could sort of say, the window would have been May to June, perhaps more late May into early June could be the turning point. So then you sit down and you think, okay, now what have we got going on here? Is the market up when it should be? Yeah. And then also on a forecast, there's a couple kinds of forecasting models, Jim, whereby you can get on trend and say, hey, it's going to keep going, which is one forecast. But if you have a forecast that attempts to make a call for a reversal sometime ahead, you're actually dealing with two forecasts. First, the up, which we've got. And then now comes the question of when does it reverse and go down, which is then the second part of a forecast. So extrapolations are easy. So anyways, the thing that helps you is then you come up with a checklist of, is it up when it should be? Yes. Are there signs of speculation? Yeah, you've got valuations extremely high. You've got sentiment numbers have been extremely high. And now we're getting technical readings that are high. So you say, okay, that's checklist. Up when it should be, up to becoming speculative? Yep. And then something like a third point is, what is the story behind the drive in the market? And you look around and what kind of a story is driving it? It's just more or less feeding on itself. The market is going up, and then you've also got other people, like the public is now in the market and using particularly ETFs. There's been a fair trade switching out of mutual funds and into ETFs, which is something more direct. So you got the public in now where they haven't been in for some time, and this, I guess, was prompted by the election in November in the States, which then is potentially a pro-administration government, which is good for stocks. So anyways, you've got them in. Now you also have central banks have been buying equities, which is some form of madness. The central bank should be looking after the reserve that is backing the currency. But that's very old-fashioned, and these guys now, it started, who knows, maybe about 15, 20 years ago, where they had reserves and maybe a good portion of it in the senior currency, the U.S. dollar. But they looked in, with declining interest rates, because they would maybe park some money out to, one-year maturities in U.S. Treasury bills, and the return stopped there. But they shouldn't be thinking about a return on their reserves. So anyway, so then with interest rates coming down, the returns on their money that they had parked were becoming unattractive, and then they persuaded themselves that they had to get into equity. So the central bankers have been positioning equities for their reserves, and it's sort of applying modern portfolio theory to the long tradition of what a central bank should be doing. But then it's a time, kind of the point in financial history where anybody can do anything with impunity. You can do anything and you're not going to get injured. Well, this is sort of the attitude that prevails now. So you've got three sort of players in the market that, the third one was, I read the other day, a sophisticated spokesman in the markets, that the U.S. plunge protection team is probably in the market as well. So there you've got three vested interests, or two vested interests, the central bankers plus the plunge protection team, and plus the general public. And I'm not criticizing the general public, it's just that at the end of a great bull market, everybody will be in the market, and this is what's happening now. So it's fascinating, and it'll be interesting to see how it resolves.
We'll have more with Bob Hoye right after the break.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, Home Capital says its high interest account is down to $110 million. Are they close to being wiped out?
Yeah, I guess so. I'm not that close to the story, but when you have an aggressive lender, as they were, and you get a change in the credit markets and a little change in people's tolerance for risk, then these very aggressive, and it's been happening in history. I remember one in 1772, mania, where the Ayr Bank in Scotland came in, and they were going to show the old banks in London how to really, we're young, we're modern, how we can really do business. And then, of course, when things tightened up, they crashed, went bankrupt. And actually then in 1776, the book, The Wealth of Nations by, what was his name? Anyways, he used that as an example of things. So here you have now in Canada, aggressive lenders, and the market tide turned against them, and they're in a retreat. Oh, by the way, the Wealth of Nations, Adam Smith. So, anyways, that's in a retreat. And when you get one of these things retreating, who's going to really come in and fix it? Nobody. And this then gets us to the point of one of the touts behind forming the U.S. Federal Reserve was as a lender of last resort. And that theme is that when you have a company such as this one or anyone in the States that is overextended and the market forces are going against them, the theory is that the central bank will come in and be the lender of last resort, bail them out, then all will be well. But the problem is that when you're in a mania, everybody gets reckless. And so you then have a whole bunch of companies of various kinds or various kinds of lending agencies who are fully extended because that's the mania. So the idea of bailing one out and it would prevent a contraction has, in theory, it's a great idea, but it's never ever happened. And the great contractions, because you had in England, the first central bank of issue, the Bank of England, which was formed in 1694, and then by that time you had in London enough different companies being traded and enough traders and public in it, you could call it a stock market. And then you had a long expansion, and the commodities peaked in 1711, and then there was some hardship, but nonetheless, everything settled down, and then the whole of London discovered stocks, and the key company was the South Sea Bubble, sort of a quasi-government scheme that was putting lots of money into the Treasury and things like that, so everybody wanted the bubble to keep going. But in June of 1720, the whole market blew out and then turned around during the summer months, and then after September went into a crash, where such that the South Sea Company, where the high had been pretty close to £1,000, went down, and the bubble started at about £120 a year and a half earlier, and then crashed back down to the £120 level, devastating quite a few investors. So this is of interest, that the 9 years from when commodities peaked to when the stock market peaked. So you can go back further out to the number 5 bubble, which was 1929, and commodities had a huge peak in 1920, and then crashed, and then the speculation shifted over to paper in the stock markets, and you had the high in September 1929. So, and here we have now the last really big high in commodities was in 2008. Add 9 years on, what do you end up with? My arithmetic says 2017. And here's another way of looking at it, is you have this 9-year thing on the big window, on the big picture, and then you then step back and say, okay, this is a year where if you're going to have a stock market bubble and have it reach a climax and quit, is that happening? And that's what we talked about a little while ago, whereby technical and sentiment readings are exceptionally high. So long-term picture looks like this could be the year when a bubble blows out, and near-term readings say that the stock market is quite excessive now. So let's give ourselves some open window here and figure that somewhere after mid-year, the credit markets could change, and then you could have the U.S. market taking another run up to some kind of a rally into September, and then perhaps liquidity problems in the fall. It's an old and classic model.
We'll have more with Bob Hoye right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Bob Hoye. Bob, a listener has a question about gold mining juniors. Are they still a bargain?
Yes. The gold mining precious metal sector has been a tough one since the huge blowout in 2011. And the market has enjoyed a couple of rallies, but they've been rather brief. The one this year was brief, and then the one last year in 2016 was a really, it had a good sharp rally and then gave up. Now, we're in a transition, I think, from the old gold bug story where central bank is evil and you buy gold to get even against those evil guys. And I think we're heading towards more of an investment climate where people will look at the gold mining stocks and look for profitability in those companies. And one of the things in gold mining is the ratio between the cost of mining the gold and the price they're getting for the bullion. And this we look at in real terms, where you take and deflate the gold price by the producer price index, and it gives you real terms. So what we're looking for here now is that in previous post-bubble contractions, the real price of gold has gone up, and it restores profitability to the gold mining sector when profitability and most everything else is having a serious problem. So, we've got a couple of indicators we're looking at here for a little more basing. We call it our comfort indicators, whereby you want to have the real price of gold going up. It needs to go up a little more. And then you want to have, for example, say the gold-silver ratio, with silver beginning to outperform gold, and that's not happening. And then the other one you'd want to have would be, for example, the price of gold shares. We use the old Hoye index relative to the bullion price. And you want to have the gold shares beginning to outperform the metal, and that isn't really happening either. So I think there can be a lot of money made in the precious metals sector, but it's not going to be tomorrow or over the next few months. But at some point, all of these indicators we use will fall into place, and we'll come up with the buy signal. But we're not certain when that would happen. But the comfort is that in every post-bubble contraction since the early 1700s, you have had a long bull market for the real price of gold, and eventually the gold miners have been the premier investment, tremendous performance. And then to get back to the question about the juniors, then the juniors will do exceptionally well within this climate, but not quite yet.
Bob, thank you so much for answering that question from Justin Lee. And we'd like to encourage our listeners to send in questions for Bob or for the show, for any of our guests, to info@howstreet.com. Bob, have a great weekend.
You too, and the weather forecast is great.
You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.